Do you ever feel like the energy world's running a live demo of chaos theory on Wall Street while everyone else is just betting on coin flips? Good. Mark Roach here with FutureWise Energy, where we crunch through the sector shaping the grid's destiny, armed with the hard numbers, rig counts, production surges, consumption shifts, and the market's ever-glitching price ticker. Let's hit pause and rewind for a second. Remember the days when U.S. energy foreign policy meant investing for decades in regimes sitting on tops of oceans of oil, troop deployments, air bases, secret handshakes at OPEC galas? Now the game much looks like an improv sketch. Heads of state trade face-to-face declarations of price wars, cameras rolling, global traders toggling alerts like kids on energy drinks. We spent decades writing blank checks for regime stability, propping up distant thrones. Now we micromanage the price of a barrel with hashtags and press conferences and threats. Now here's the real-time plot twist. The U.S. consumer base, long considered the darling of the free market, may have been coasting on a bubble blown by nuclear-era security guarantees. Maybe the confidence in America's ability to buy and dictate energy flows isn't born from raw market muscle, but from the quiet shadow of fleet-based deterrence clicking away in the background, while we confuse superficial price spikes and dips for the real gears turning underneath. First, zoom out. WTI crude is clocking in at $63.95 a barrel. Brent at $66.80, and U.S. natural gas perched at $2.84 per MMBTU. Numbers move fast, a two-day dive in multi-month lows, then a modest 1 to 2% rebound. U.S. gasoline, the stalwart, $3.16 a gallon, barely budging, but that's just calm in the eye of a market storm. Let's talk rigs. Over 500 oil rigs are active across the lower 48 in the U.S., with the Permian and Eagle Ford leading the charge. Reliable as Sunrise, pumping out more than 12 million barrels a day. The gulf between OPEC discipline and U.S. output grows wider each month. Saudi Arabia tightens, Texas and New Mexico just reload and pump. It's not just oil. The natural gas front is a record breaker, 105 billion cubic feet per day, shrugged off by demand that stays stubbornly flat even as liquefied natural gas exports hit new highs. Storage is the bank shot here, 7% above 5-year averages. Inventory charts stacking up as if the law of summer cooling loads never got the memo. Regionally, the Northeast sends production through expanding takeaway capacity, while the Gulf Coast flexes LNG export muscle. Shipping barrels and BTUs east of Europe shakes off a Russian winter with backed-up storage. But don't fall for yesterday's numbers. Compare this year's production with the last. U.S. output is up, but the number of new wells drilled per rig has leveled off. Efficiency is king, but the easy gains are over. Every marginal barrel takes more coordination, pad drilling, AI-driven offtake optimization, and relentless water and sand logistics. In shale, capital turns faster than a gregarious lobbyist at an industry gala. Declines are steeper, so drillers chase shorter cash-on-cash returns, betting the market stabilizes before Wall Street patience dries up. Grid resilience. Well, here's where the numbers bite back. Texas isn't just about boots and big hats. It's about ERCOT volatility, where gigawatts of demand can swing in a heartbeat, and renewables are notorious for playing hide and seek. The analytics don't lie. Every $1 million invested in grid-scale batteries yields incremental flexibility worth 2 to 3 times that during a peak event. Batteries, especially 4-hour lithium iron phosphate banks, stacked 20 gigawatts onto the grid in a record time. Still, every major curtailment says we need smarter controls, better price signals, and real-time granular visibility from substation to socket. Transmission expansion is still in a political molasses. Interconnection queues thicker than Houston humidity. Now, storage economics. Forget last year's hype. Now the boardroom questions are about congestion relief, black start, and capturing those fat transient intraday spreads. 4-hour storage is table stakes. Long duration pilots, think pumped hydro tweaks in Appalachia. Vanadium batteries shadowing congestion at substations. These are angling for a payday where gas pipelines are maxed or wheezing. Mid-continent market? A sudden gas price spike above $2.85 per million BTU triggers storage dispatches that stabilize not only the grid, but traders' nerves on the other end of the screen. The real opportunity is in stacking revenues, ancillary services, capacity, frequency response, and automating asset deployment with dynamic envelopes and forecasting that beat the curve, not just follow it. Clean fuels and hard-to-abate sectors, aviation and shipping burn through millions of barrels daily, while steel and cement move mountains in CO2 terms. The green hydrogen story is all about utilization. Unless you're running those electrolyzers flat out and securing cheap surplus power, the math gets fuzzy. Last week, wholesale power in key ISOs cleared at just under $30 per megawatt hour, which helps, but only for the lucky projects catching curtailment. Synthetic fuels like e-methanol or sustainable aviation fuel from municipal waste are placeholders, playing tag with infrastructure, useful to hedge regulatory risk and keep supply chains awake, but scaling slow compared to demand. The fix: bundle production at hubs, chase waste streams, and ink contracts where carbon intensity is a line item, not window dressing. Watch for the uptick in carbon contracts for difference. Real dollars for real emission cuts. Showing up in the next wave of project finance docs. Critical minerals. Get ready for the supply chain soap opera. U.S. lithium production has ticked higher, but still can't touch Chinese and Australian volumes. Copper, the unsung hero of electrification, with prices reconnecting to fundamentals as any whiff of port disruption moves markets. Industry insiders know it's a 15-year cycle from exploration to production, so pragmatic actors are shifting to substitution. Cheaper chemistries, flexible supply agreements, and recycling partnerships. This is where rare earths get interesting. New separation tech is testing scale, but most U.S. magnet demand is still fed by powdered imports, vulnerable to geopolitics and trade spats. The play: buy into offtake agreements that lock in recycled feedstock and push for investment in process innovation, direct lithium extraction, low acid leaching. Because if your margins depend on single mine or port, you're living dangerously. Policy and markets, that's the battlefield where volatility gets tamed into cash. Project stacking incentives, think accelerated depreciation, grid services, and production credits, make the slow stuff look prehistoric. Permitting remains a Rubik's Cube, gumming up gigawatts in paperwork. The winners? They steelman their community pitch before the first town hall, mapping out bill credits, job creation, and resilience hubs. Digital MRV, measurement, reporting, and verification, is creeping out of compliance departments and into revenue models, especially as carbon markets shift from annual averages to hour-by-hour, location-tagged data. Verified carbon is the new gold, and digital twins are everywhere, modeling emissions, simulating outages, and giving investors a dashboard they can actually trust. Now, digital intelligence, production, rigs, refining, midstream flows, formerly siloed, now streaming in full spectrum digital. Everyone's swimming in data. Phil in North Dakota is adjusting water cuts from his phone while analysts in Houston are running machine learning models on pipeline pressures. Still, the money lands where numbers meet action, predictive dispatch for battery fleets, fast fault detection that issues maintenance orders in seconds, dynamic pricing that helps industrial loads dodge demand spikes. Cybersecurity is the rising cost of doing business. Zero trust isn't a slide, it's a required operating system, from firmware updates to SOC alerts. Anything that doesn't tie directly to operational cash flow is just data noise. So what's the punchline from FutureWise Energy? When WTI ricochets around the low $60 barrel, it escapes gravity and gas claws its way back up from 9-month lows. The only way forward is building redundancy into everything. Hardware, contracts, fuel sources, supply chains. The old world was about bets on geographic dominance, and today it's about operational agility and systems intelligence. Watch the pipes, the volts, and the price curves, and especially the gaps where they all intersect. Operators who stack flexibility, audit their data, and never assume last month's means anything for next month are the ones who turn market noise into a sustainable edge. If your designs, investments, and strategies don't get smarter and sharper under pressure, you're one headline away from trouble. Real resilience is proven when the system's stressed and you're still in the black. Let's tune out the market static and tune into the only metrics that matter: measured resilience, defensible economics, and designs that adapt faster than headlines can shift. If you want to build energy assets for the future, get comfortable with the static. It's the sound of risk being turned into opportunity. Mark Roach, FutureWise Energy. See you on the other side of the data stream.